First there was the fiscal cliff, now sequestration with its uncertain but very likely severe impact. Down the road we've got the debt limit. Nobody knows what Europe's going to do. So what is an investor going to do? Let's talk to Jim Cahn. He's the Chief Investment Officer at Wealth Enhancement Group. Jim, we also have this roaring stock market where price-to-earning ratios are looking pretty good. How do you deal with this as an investor?
Well, that's a mouthful. There are a lot of headlines out there right now, and so investors are pretty confused. And our answer is, anyone who tells you they think they have the answer probably doesn't, right? So the right answer is to say, we really don't know exactly what's going to happen in the future.
But we have to position ourselves for something, and so there's a lot of fear associated with, for example, sequestration right now. We're into the first full week of that.
Right, so that's it. So sequestration is a perfect example, right? The government's cried wolf a few too many times, and neither individual investors nor Wall Street believe that the government has the guts to really throw us back into a recession that would shed jobs, that would cause a lot of hardship for the U.S. population. And so we keep thinking, they're going to kick the can down the road once again, and they do every time. So I think this might be the fourth or fifth time
we've certainly seen
this.
that proven with early in the week. The markets have done relatively well. It's a non-event almost.
It is almost a non-event. So if you look at sequestration, the U.S. government spends $3.8 trillion a year. We're talking about cutting somewhere between $65 and $86 billion out of a $3.8 trillion budget. It's 2%. If you ask me to shave 2% off my spending, probably wouldn't affect my lifestyle all that much. And if the government can't shave 2% off its spending, we've got bigger problems.
Jim, a lot of people have been doing really well investing in companies, and we see these valuations very high right now.
Yeah, valuations, so if you look at the stock market and you look at the S&P 500 and the Dow Jones, people are saying, geez, it's returning to the levels of 2007. Aren't we getting a little lofty again? And the answer is no. So if you look at how companies are actually performing, they're making a lot more money today than they were in 2007. So on a pure valuation basis, companies actually look reasonably priced.
That's interesting because people take a look at all-time highs. We're very close to them again, and they're thinking, wow, this is an overpriced environment.
Yeah, people get fixated on these numbers, right? But really, it's just a number. It doesn't mean anything. So the question is, what am I buying in the form of earnings? So if a company earns $1 in 2007, right, and the stock was $10, and today they make $2, and the stock is still $10, I'd much rather own the stock when it's making $2 at $10 than at when it was making $1. And so, basically today stocks look much more attractive than they did in 2007.
And the retail market is certainly understanding that because there's nowhere else to really put your money to get any decent gains.
Yeah, the problem with the retail market, though, is a lot of people chase returns. So what they do is they'll wait for the stock market to run up, and then they'll put their money in, and then when the market falls, they'll take their money out. And so if you look at the return on individual investors' accounts, right, it's not the same as the stock market, and that's why people do need help.
Jim Cahn from Wealth Enhancement Group. Thanks for the reassuring words.
Thank you.